Hey traders, this is Blake Morrow with Traders Summit, and with me today I have Mr. Dave Keller. You are the chief strategist, at Stock Charts. Is that correct?
That's exactly right. Yeah, we're based in the Pacific Northwest in Redmond, Washington.
That's awesome. Well, it's great to have you here. And I have to say personally, I've been a big fan of yours for many years. I've followed you over the years on Twitter, and it's really nice to actually have you here one-on-one, sharing your knowledge and your experience and what you're looking at really with the Traders Summit community. So thank you.
Yeah, congrats on what you guys have done, Blake. I mean, it's been fun to be involved and get more involved with Forex analytics. You guys have done a really fantastic job. And yeah, if anything we share today helps nudge people's thinking about how to approach investor psychology, trading discipline, I'm all for it.
Well, I appreciate that. So let's talk, Dave, let's talk a little bit about what's happening right now, because right now, I know I'm not the only one. I think everybody's been looking at this big ascending wedge in the markets for like let's just call it the last year or so. We kind of broke down last week. We're bouncing today following the FOMC. I think it's caught a lot of people off guard. I think people are a little wrong-footed right now today specifically. But more importantly, what are you seeing beneath the surface of just the S&P? What are you seeing personally?
Yeah, so I mean, when you think about the technical characteristics of the market, really the broad market environment, I think of it as sort of the push and pull of two opposing forces right now. You mentioned the Fed meeting this week, and you had the gap down on Monday, which is kind of a drop in stocks, kind of an unusual drop, an unusually sudden drop for the S&P year to date. But the trend, the long-term trend, I mean, the fact that just the chart goes from bottom left to the upper right and a consistent pattern of higher highs and higher lows just shows the strength in the S&P, right? The S&P, the NASDAQ, every month in 2021 has made a new all-time high. And generally speaking, until that changes, the path of least resistance appears higher, especially given the Fed's continued comments that they're going to be as accommodative as possible. And somehow they're dancing this amazing dance of broadcasting that they will be less accommodative, but still implying that they're super accommodative. And the market so far appears to be buying it this week. But overall, I think on the other side of it, Blake, I think the challenge is the technical conditions have become more and more, frothy is kind of a way to describe it, but I think of it in terms of breadth. The breadth conditions have been increasingly more negative, right? A lot of stocks have been breaking down. So while the broad indexes have been going higher, underneath the hood, if you look at a lot of sectors, a lot of individual names, you're finding plenty of names that have not been making new highs really since April, May, June. That's when they sort of topped out and they've been rolling over. And the question is there enough deterioration there to weigh stocks down? I think earlier this week, you got some of that where the S&P broke below its 50-day and closed below it for 2 days in a row for the first time year to date. You had the S&P undercutting its swing low from August, making a new swing low is compelling. So you're getting a bounce this, so far through Thursday. But overall, I think the challenge is this beginning of a deeper rotation, a rotation away from continued strength and showing some weakness under the hood.
And you mentioned one of the most basics of a trend is just a higher high and higher low on a monthly basis. But based on the chart that you're seeing right now, let's just say that today was the last day of the month. We'd actually made a lower low this month than we did in August. Is that correct?
That's exactly right. And you hit on, it's called Dow theory. Charles Dow, over 100 years ago, who's called the father of technical analysis, basically laid out how to quantify a trend. And I find a lot of times traders get really caught up in the flickering ticks and the short-term movements. And what Charles Dow said was take a step back and look at the long-term trends. And basically higher highs and higher lows are an uptrend, lower lows and lower highs are a downtrend. And just simply looking at the trends in the market, the trajectory in this chart or in any chart tells you a lot of what you need to know about the overall push and pull and how days like today fit into the longer trends. Undercutting the low from August, I think, is a concern. The RSI getting below 40, that happened there as well. That's the lowest that the momentum reading has been year to date. And both of those things speak to a market that is, suggesting further downside, not one that's sort of, setting up for another spring to new all-time highs.
That's interesting. And I notice you have a moving average there. What's the significance of that moving average that you have there?
Yeah, so the 50-day moving average, what is great about the 50-day moving average this year is it's been so consistent. And I'm not the only strategist that's picked up on this very straightforward thing. A moving average is simplicity. It basically is designed to take the noise out of the chart. So it's a 50-day average of the last, an average of the last 50 closing prices. That window moves along. So you get this smoothed out movement in the market. The moving average has been sloping upwards since last November when we came out of that congestion range. And the prices hit the 50-day 4 or 5 times so far year to date, and every single time has bounced back to make new all-time highs. So that's a great consistent pattern. It's easy to buy on the dips and keep buying for the next leg higher. But one of my mentors, Greg Morris, always said, new highs are always bullish, except for the last one. So if we hit that last new high, all of a sudden we start to deteriorate. We're unable to make a new high. We break down through the moving average. And something like this, when so many people have keyed in on it, when we realize that the 50-day is no longer holding as support, when we recognize that short-term weakness is too much and buyers are not coming in, that's when you can get a panic, a waterfall decline. When people sort of rush to the exits, everything comes down. And I don't know if that's necessarily going to happen, but we're seeing the conditions similar to previous waterfall declines for sure.
That's interesting. So Dave, you'd mentioned, while I have you here for the next just a couple more minutes, you mentioned there's some deterioration underneath the hood, if you will. Is there anything else that's really jumping out and saying, hey, wait a minute, let's be cautious?
So this is one chart I would highlight, and market breadth are basically just a group of indicators that help you understand the stocks that make up an index. So the S&P 500, the NASDAQ are doing certain things. By looking at breadth indicators, we get some color on what the 500 stocks that make up the S&P, what are they doing? Because at the end of a bullish phase, you usually have the market keep going higher, but a lot of the stocks actually break down because people are going into the defensive areas, mega cap stocks there's enough cap there that will push the markets higher or push the index higher, but a lot of individual stocks are struggling. So if you look at the percent of stocks above their 200-day moving average, right now the S&P is well above its 200-day, about 5% above it's 200-day. Back here in April, 95% of the S&P members were above their 200-day moving average. As of yesterday's close, it was just below 70%. So wow. About 25% of the S&P has broken down through its 200-day moving average. About 92% were above their 50-day. It's down to around 37%. So you have almost, 55, 60% of the S&P members breaking down through their 50-day moving average as the S&P did this week. So while the S&P is not far off of all-time highs, a lot of stocks have actually already been rotating lower. I've described this as a stealth correction, right? The markets can correct in price, as you saw here in March of 2020. They can correct in time, which is what you saw September and October of last year, which is more of a holding pattern before you resume the uptrend. I would argue the last couple of months, we've been in a stealth correction, which is where a lot of individual names are struggling while the indexes are going higher. And the question is there enough deterioration in those individual names to pull the markets down as a whole? And I think that's what this week we're starting to see, that is potentially a scenario to think about between now and year end.
Well, Dave, I tell you what, this look and how you're viewing the markets has been super enlightening. And, when I think of you, and I've thought of you over the years since I've known you, I've always said, Dave, Keller CMT. And so can you tell us as viewers and people that maybe don't know exactly who you are, what's been your association with CMT and how long have you had that designation?
Yeah, great question. So I've been in the industry for about 21 years now. Most of that was in the Northeast, in New York and Boston. I was at Bloomberg in New York and then at Fidelity up in Boston. I ran the technical research team for about 8.5 years. And during my time at Bloomberg, I was learning technical analysis and came across the CMT exams. And I had a couple mentors, guys like Ralph Acampora, who really taught much of Wall Street how to use technical analysis. He taught at the New York Institute of Finance for 50 plus years. Jeff Weiss, who's a technical analyst at Miller Tabak and others, all sort of taught me this toolkit of technical analysis. The CMT exams really formalized it. And CMT stands for Chartered Market Technician. So if you've ever heard of the CFA exams, which hundreds of thousands of people have to understand, balance sheets and income statements, the CMT helps you understand market psychology using charts. And what I found is before the CMT, I was sort of an amateurish technical analyst. I was probably more dangerous than helpful in terms of my ability to look at charts because it wasn't very disciplined. After the CMT process, I learned how to really do it with a consistent way. That's when I developed my own checklist, the steps that I would follow to analyze a chart. And I came out a much better strategist, a much better investor because I understood risk versus reward a lot better than I did before. Well,
I'll tell you what, stock charts is very, very fortunate to have you, as their chief strategist. So, Dave, I want to say thank you so much for spending the time with the Traders Summit community. And for those of you that don't know how to find Dave, make sure you click below at his link, and you can get directly to him. And then also, Dave, I love reading your stuff when you post a Trader Summit, and I really look forward to the next time that you and I get to sit down and see what's under the hood of the market.
Happy to do it anytime. And Blake, congrats again with what you've done with Trader Summit. Happy to be a part of it.
Thank you very much, Dave. And we'll talk to you very soon.
Sounds good.